What's up, good people? It's Natasha Varela, the Moneyista, your tax strategist, real estate investor, business owners. I want to talk about the questions that I get the most. And one of them is, how do I live 100% tax free? So 13 years in the IRS has taught me a lot. Being an accidental investor, right? So I purchased my first condo. My first property was a condo, and I lived in it as a primary resident. What ended up happening, as we all know, condos have HOA fees, right? Assessments. It just was a big mess. It was a new development. And so, the common charges, as I learned, and I learned a lot from this experience. Condos are very, very risky, right? They're very risky investment, a very risky investment strategy. Now, luckily, it wasn't my investment strategy. And unluckily, I didn't know it shouldn't have been my first purchase. So what happens is, particularly with new developments, right? You have your developers. The developers are called sponsors. Right, they're interchangeable terms, and what happens is they take out a construction loan, and they build the units, and then they sell them off, right, to pay back the loan and hopefully make a profit. They usually utilize a specific bank. That's why when you go to a lot of new developments, they have a preferred lender. That preferred lender most likely gave the construction loan, and they want to make sure they make their money back. And what happens is the sponsor or developer, they artificially keep the common charges down because they want to make the units attractive, right? And so a lot of times they'll use some of the construction loan to pay the carrying cost of the development, right? And it seems attractive to buyers, right? Oh, these are very low HOA fees. That's great. You get all this stuff. So at some point, the developer, sponsor, however you want to call them, has to hand over, the finances to what you call the condo board. They have to form a condo board. And once we were handed over the finances, we started to see the true operations of the building, right, the community, and the common charges had to shoot up because now the sponsor was no longer able to put money in from whatever proceeds from the loan to cover the cost to keep the common charges low, or should I say artificially low. And so right away, everybody's common charge shot up, right, every month by hundreds. And this is not something you can control, right? You can't veto it. It's got to be paid because you have expenses. We had a doorman, we had elevator maintenance every month. We had to keep the common area clean. We had to service, pay the sewage, all that good stuff. Service the trash, chutes, and things of that nature. And of course, because it's a new developer, we had some architectural issues, right? Sometimes developers, they want to cut costs. They try to fit a square peg into a round hole. And we found that the water heaters weren't the right water heaters or whatever have you. And so that costs hundreds of thousands of dollars, right? And that comes in the form of not increased common charges or HOAs, right? It comes in the form of what you call assessments. Assessments are not reoccurring charges. They are one-time events that occur that are not expected and have to be paid, And they usually come from the unit owners. And so, that's why I say, condos, HOAs, they're not a good investment strategy. The risk is very high. You have HOAs, you have assessments that come along. I had so many to the point where my HOA fee with the assessments was more than some people's property taxes. So I say that to say I moved out immediately. I want to say not immediately, 3 years later, and converted it to a rental. And from then on, I started to really invest because I saw the difference in my tax return, right? From being a primary resident homeowner to being an investor. And from there, I took it even further and began to purchase more real estate, right? And I did a couple of things that were risque, right? And I don't encourage people to do this on their own just to do it, but I pulled all my money out of my 401k at the time, and I paid off my student loan so that I could look more attractive to lenders. And because I had property already, and I utilized the tax code, with rental property, including depreciation, bonus depreciation, utilizing it as a short-term rental so that I can offset all of my income, right? So when I took the money out of my 401k, I offset the tax liability with my rental. And so I just began to purchase rental after rental after rental, okay, utilizing the tax code, because real estate is very strong in the tax code. It's probably one of the strongest, parts of the tax code. And then, business ownership, right? And the two are kind of similar in that, it's income, whether it's rent or your services or goods sold, expenses, those expenses associated, right? Whether it's a rental or goods or services sold, and then you're taxed on, or your profit, right? If you have any. And a lot of times real estate doesn't have an actual tax profit, right? You might have cash profit, but you don't have tax profit because there are things that you get like depreciation that you don't really pay that kind of offset the tax liability. Okay. So with that being said, all the money I saved in taxes, right, from utilizing real estate, I was able to accumulate more and more properties, right? That was my strategy. Did I eat ramen noodles and tuna sandwiches? Some points I did, but it was temporary. Some things are just temporary, guys. Everything is not going to be smooth sailing. Everything isn't going to be super easy. Everything that's worth it hurts just a little bit. It just a little bit. But it was worth it in the end. I won't sell you a dream and say, you're going to make thousands upon thousands of dollars per property. You have to do your homework. You have to research the area. You have to make sure that you're going to cash flow. And if you utilize the tax code, you can tax flow greater than your cash flow. And so if you want to learn more, go ahead and go to the link in the description box. You can join the Tax Strategies Mastermind. It is deductible to business owners, real estate investors, and those who are startup business owners, right? So if you're going to acquire property or start a business, it is a startup cost to you. And it goes for real estate investors and business owners, coming straight from an accounting professional with a special niche in tax. Okay, and an enrolled agent, a former revenue agent. So that being said, it hurts a little bit, but I have accumulated probably 7 properties now that cash flow and have tax flowed. So great. And my rental income is protected because I utilize lease protection insurance, which means that if the tenant defaults on paying me rent, as soon as I gain access to the unit or possession, right, they're evicted or they leave voluntarily, I am paid all the back rent from the insurance company and any rent moving forward that is still left on the lease, provided that I don't re-rent the unit. All right. And legal fees as well. So I am protected. I'm an auditor first. Okay. I always go for preventative measures. Preventative measures keep you protected. Okay. It's not likely that I get an unscrupulous tenant because I make all my tenants go through my lease protection insurance. So the insurance company does the credit check, the income verification check, all that good stuff. And then once they pass, it's a free application, they do have to pay a fee to be insured. And I include security deposits so that they don't have to pay me security deposit. And it's just easier for them to move into, right? And this likely draws in a good kind of tenant, right? A tenant with a great profile who's not going to skip out on rent because they know that should they skip out on rent, they'll be evicted, or even if they just leave, I'll get my money as a person that's insured, and then the insurance company will always find you, right? It's not like I have to go to court and fight for my rent. So that's great. I have a great pool of tenants. It protects me. It opens the doors for, non-traditional criteria for tenants to live, right? A lot of people don't have steady income, but they're business owners. They have enough income and they need just a little bit of help. There are people who have a lot of income and their credit's not so great, so they need a little bit of help. So it's kind of a mutual benefit to both parties. So go ahead and click the link in the description box to join the Tax Strategies Mastermind or my free live training. All right. So I'll see you guys later.